So the capital budgeting process, first question. The following schedule reflects the incremental costs. See, this is relevant for decision making, right? And revenues for a capital project. The company uses straight line depreciation. The interest expense reflects an allocation of interest on the amount of this investment. So the interest expenditure has been incurred for this particular project. It seems that's the reason why it has been allocated to this, which is based on company's weighted average cost of capital. I know WACC is a new concept for you, but don't worry. This is like the required rate of return, right?
Yeah. Okay.
Ah, yeah. Revenue, everything is given to you. Revenue, the income statement is given, and net profits are given. They are asking you the annual cash flow for this investment before tax considerations would be. That means they're asking you cash flow before tax. For that, we should have some good idea about cash flow statements. Okay. Okay. So I will give you a small hint of this. See, they're asking you operating cash flows. What they're asking you?
Operating cash.
So if this is an income statement, you'll be having gross profit brought down. Let's say it is 1 lakh. And to rent 10,000, to salaries 10,000. So what is your operating profit? 80,000, right? Hello.
Yes.
So, but like they will be giving you some more information I'll give you. So we want 80,000. This is called operating profit, not the net profit, because if I have some more data like some other expenses like depreciation and interest, then my net profit, then I can find out my net profit. Why? Because these are only operating expenses, right? So for that, I'll give you a video of cash flow statement to understand.
Okay.
Gross profit brought down again 1 lakh. To rent 10,000, to salaries 10,000, to depreciation 10,000, to interest expense 10,000. See, this is a non-operating nature expense. This is the non-cash expense, and your net profit is 60,000, right? Correct? Hello.
Yes, sir. Hello.
So out of this 1 lakh total, when we remove this 40, we got 60. So
Yeah.
we have been given this net profit, but we have to reach to operating profit. And from operating profit, we need to get operating cash flows. Are you understanding?
Okay.
Okay. So the thing is what we can take here is we will take net profit first. So the net profit given to you is, so if you want to reach from net profit to operating profit, whatever you have deducted here, non-cash expense, depreciation is a non-cash expense where the cash has not gone. And we are finding out the cash flows, right? Which is important for capital budgeting process. The accounting profits are not important, but the cash flows are important. So non-cash expenses, and this is non-operating nature expense, right?
Yeah. Okay.
Actually, this allocated interest also is kind of a non-cash item. See, they have given you interest expense 8,000. So to arrive allocated interest actually is a cash outflow. Let me be very frank, but they have given it as a non-cash expense. Just a second. Just a second. So So this allocated interest is kind of a non-cash expense actually. See, interest paid is something. This is just allocated now. Allocated means that has been kept in that category, but amount has not been paid. Are you understanding?
Yeah. Okay.
See, if you pay interest, then what happens? It is an outflow. This is a allocated interest. Just it has been kept in that category. They have clearly mentioned here. So I will consider it as a non-cash expense. This is a non-operating expense, but it's a allocated interest. See, they have given here. The interest reflects an allocation of interest on amount of this investment. Allocation, that means we have just allocated, kept aside. Okay. But
Okay.
whether paid or not, that status is not clear. So just we have allocated. That's the reason why we keep it as a non-cash expense. Are you understanding?
Hmm.
So we start with net profit. Net profit is how much as per the question? Net profit is 1,92,000, correct? Now, add non-cash items. What is non-cash item? Depreciation. So here also I just forgot. I am having net profit 60,000. If I want operating profit, I have to add back the expenses which I have deducted, right?
Yes.
Why I have to add back? Because removing this, I reach to net profit. So adding this two back, I'll go to the old profit, right? Old figure. Correct. Allocated interest. So what is my operating profit? I'm getting 80,000. Correct. Can you see here 80,000?
Yes, sir.
Yeah. So generally this non-cash item I'm just adding. So non-cash item is like 70,000 is a depreciation and like allocated interest. That's the reason why clearly I'm mentioning allocated interest 8,000. So this will be my operating profit. But the thing is, I don't have any other item. See, in cash flow statement, after getting this, you get operating profit. Okay. But you have you have to add or subtract the changes in working capital elements, right?
Hmm.
What are the working capital elements? If at all inventory opening balance was 10,000. Today closing balance is 12,000. Inventory has increased. That has increased the cash or decreased the cash?
Decrease.
So 2000 I will subtract, right? So working capital elements are nothing but inventory, receivables, okay, and payables. So all increase and decrease in this we will adjust. Then finally we'll get one figure that is called cash flow from operating activities, right? I'll give you a video. You can better understand.
Hmm.
You got some idea, right, in this?
Yes, sir. Yes.
So that's what we are doing. So here we have no working capital elements. So whatever I'm getting is my cash flow before tax.
Okay.
Before tax cash flow. They're asking that only. So please make a note of this. And my answer is 2,70,000.
Okay.
Yeah.
Sir.
Hello.
Yes, sir.
Done, right? So we'll go for the next
Yeah.
question. Yeah. So this you have to remember what I have done. Please remember this. The questions are really very big in this. What we are doing. This is, something Very like lengthy section. Let's go for the next question. Oslon Industries needs to add a small plant to accommodate. I'll open a new page. Why? Because this will not be sufficient. Oslon Industries needs to add a small plant to accommodate a special contract. So they want to buy a plant, it seems, to supply building materials over a 5-year period. That means to sell the building materials, they want one more plant. Required initial cash outlays at time 0 are as follows. That means this is at the beginning of the project, right? Now,
Yes.
cash outlay. And Oslon uses straight line depreciation for tax purposes and will depreciate the building over 10 years and the estimated and the equipment over 5 years. So building 10 years depreciation and equipment 5 years depreciation. Okay. Now, Oslon's tax rate is 40%. Revenues from the special contract are estimated at this much annually. That means you will get this much revenue from this contract. Okay.
Mm. Yes.
The cash expenses are this much annually, and at the end of the 5th year, the assumed sales values of land and building. That means this you are going to get as a cash inflow for selling those two assets, right?
Yeah.
And it is further assumed that equipment will be removed at a cost of 50 and sold for this much. Again, this you are going to get. So what are they asking? They are asking, as Oslon utilizes NPV method to analyze investments, the net cash flow for period 5 years. That means only the 5th period cash flow they're asking us. Last year. Okay. So
Okay.
last year means you see maximum of the things are there. Like at the end of the year, they are selling the building also. They are selling the like another asset, the land also, and they are removing the equipment at this cost and also selling and selling for 3 lakhs. So all these things are happening. So shall we go for the question?
Yes.
First and foremost, do you think the revenues what we are generating are also like going to be earned in the last year? Yes, this is annual revenues, right? So this is going, we are going to get this for get in the last year also or not?
Yes.
Yeah, these are the revenue and expenses are for the entire project life, right? Now, just a second, somebody, just hold on 2 minutes. Okay. So first and foremost, we'll take revenue. So this is 1.2 million, right?
Yeah.
And if we remove the expenses, and this is every year happening, right? We'll get
Yeah.
cash inflow. Okay, we'll get cash inflow. See, this is revenue, right? From that, if we remove all the expenses, expenses are as per the accrual concept. So we whatever net is or net what we are getting is cash inflow, right? Such a distraction today. Okay, and then see, one, the tax has to be paid, less tax, 40%. So 3.6 lakhs. We'll get 5,40,000, right?
Right.
And then see, this is not the only thing. We have the one more cash inflow in the so this is what is going to be for every year. We have just
Every.
found out the cash flow, but depreciation tax shield is also there, right? So what are the two assets the two assets here are, the two assets here used are building and equipment. One is 2 million, one is 3 million, right? We are going to depreciate them. Straight line depreciation is followed here by 10, 2 million by 10, right? So how much is that going to be?
2 lakhs.
Yeah, 200,000. Here 3 million by 5. How much is going to be 6 lakhs, right?
Yes.
So these are the depreciation amounts into 40%. 40% is the tax rate. So 80,000 and 2,40,000. So this is going to be 3,20,000, right? Is it right? Hello? Hello? Hello?
Hello. Yes, sir. Got it.
Yeah, are you hearing? Yeah, depreciation tax shield is 3,20,000. This is also a cash inflow, right?
Right.
So now what we will do is we will take up the things down. So this is one calculation, that is another calculation what we did. Shall we move forward? You're doing
Yes,
this?
Yes, sir. Noting down.
Yeah, okay. So you note down from the beginning, right? Where is the another section? Yeah, you can note down from here.
Done, sir. Next.
Yeah.
Thanks, sir.
Yeah. So what is happening in the final years? See, revenues, this is done. At the end of the 5th year, the assumed sales values of land and building is 8 lakhs and 5 lakhs, right? So this amount we are going to get respectively. If it is further as an equipment will be removed at a cost of 50 and sold for 3 lakhs. So land and building are 8 lakhs and 5 lakhs and equipment 3 lakhs, right? With a cost of 50. So we'll make a account. Proceeds from sale, land, building, equipment. So we are selling land for 8 lakhs, right?
Yes.
Building for 5 lakhs. Equipment 3 lakhs, but a cost of 50. So 2,50,000 is the net amount we are getting. Okay.
Oh.
So what is the, we are selling it for how much? What the current book values are how much? 5 lakhs.
2 million.
Land won't get depreciated, right? Only the building will get depreciated and equipment will get depreciated.
Yes.
So if I have to say the current book value, what can be the current book value?
2 lakhs.
At the end of 5th year, assumed values of building are 8 lakhs. And equipment we are selling. Equipment will be removed and sold for. So nothing will be left over. But building, current book value. After 5 years they are asking. So if I remove 2 lakhs for 5 years is how much? 10 lakhs, right? So after 5 years, 10 lakh, if I remove from this asset, the value will be 10 lakhs, correct or wrong?
Yes.
Correct, na?
Yes, sir. Yes.
Because at the end of 5th year only, I'm doing all this. So 5th year, this is for 5th year we are doing. Last year only we are finding out. So
Okay.
less, yeah, because these are the sales values, we'll see book value and we'll see profit or loss. And then we have to decide to pay taxes, right? because this is another type of cash flow. Correct. The same thing we were doing while doing NPV method also. In the final year, we were taking this sales value also that time.
Yeah.
Yeah, so the book value here we are using for land is 5 lakhs. Why? Because it won't depreciate. And here we are taking 1 million, that is 10 lakhs. Why 10 lakhs? 2 million minus 1 million depreciation for 5 years. So it is 1 million. Right? And here we are selling it off 0. Nothing is there. And what we are seeing here is something for 5 lakhs sold for 8 lakhs, profit of 3 lakhs, right? Gain or loss. And here something of 10 lakhs sold for 5 lakhs, loss of how much? 5 lakhs, correct?
Yes.
Something of no value has been sold for this much, so profit of 250. Then we have to pay taxes for this 40%. So 40% if I remove for the cash outflow will be 1,20,000, right?
Yes.
Yeah, we are seeing how much is the outflow. See, the reason for all this is seeing the outflow. So here the outflow will be 1,20,000, right?
Yes.
Tax, cash, outflow. Otherwise, we would have taken after from this proceeds from sale, we would have directly removed this 120. We will get the after tax cash inflow from disposal, right?
Yeah.
So I'll remove this also. Here itself I'll write after tax cash flow from disposal. So 8 lakhs minus 120 is 6 lakh 80, right?
Yes.
And here 40% I'll get benefit, actually it's a loss. For 2 lakhs there will be a benefit. Correct?
Yes.
This will be an outflow, actually. This will be a benefit. 40% of this is how much? 1 lakh, right? This also will be an outflow. So 5 lakhs plus 2 lakhs is 7 lakhs. 250 minus 1 is 150, right?
Yes.
Just make a note of this. It's a very big question. Done. So now all these things are happening in the 5th year. So now we will take up all the cash flows what we have got till now. Okay. So first of all, here 540 is like every year cash flow. So 5th year, this is also there, right? So final calculation of 5th year cash flows. So the final calculation of 5th year cash flow is the net revenue what we were getting, right?
Yeah.
So cash flow from operations. So 5 lakh 40. Then depreciation tax shield. Three lakh 20,000. This is one of the cash flows. Then from the sale of land, and then netting the tax from that. What are the cash flows you got after tax cash flow from disposal? 6 lakh 80, 7 lakh and 150, right?
Yes.
After tax cash from disposal of assets. So what are they given? Like 6 lakh, what was that? 6 lakh 80 for land, 7 lakhs for building and 150 for equipment. 6.87 and 150. Okay. From land is 6 lakh 80. From building is how much? 7
7.
lakhs, right?
Yes.
From equipment it is how much? 1
Lakh
lakh 50. Just add them up and tell me.
23 lakhs 90,000.
This is the answer. Massive question. Okay, note it down.
Hello.
Hello.
So once scroll up to tax part.
Sorry.
Once can you scroll up to taxial parts, the depreciation?
Okay, okay.
Yeah.
Yeah, this one.
Yes.
Okay. Next question. So there's a question, assume that the old equipment which has not yet been fully depreciated must be sold in order to purchase the new equipment. That means you want to sell the old equipment and you want to buy the new equipment. The entity's policy is to depreciate all equipment on a straight line basis. Given a constant effective income tax rate, the incremental depreciation tax shield during the later years of the capital project is generally what? Just read the question once again. See, they are saying you have a old equipment. Okay, so you have bought it for $100,000. The 10% is the depreciation. Okay, and it is not fully depreciated. Must be sold in order to purchase the new equipment. And let's say the 5 years is the time. Entity's policy is to depreciate all equipment on a straight line basis. Given an effective income tax rate, the incremental depreciation tax shield during the later years of the capital project is generally what? So let's say they want to buy a new machine after 5 years, right?
Yeah.
So this will reach its end life and a new machine will be bought for 200,000, let's say. Correct?
Mm.
Thus, in the early years, this will be, only 1 lakh will be the depreciation in the early years, right? And in the 5th year, when you will be buying this one also, the depreciation for this also will be there, correct?
Yes.
So in the early years, only one asset's depreciation was taken. So older equipment is being disposed of, and when it leads to when it's reaching its end of the life, right? Thus, in the early years on the project, the depreciation expense on the new equipment only provides an incremental tax benefit since there was some depreciation expenses still being recognized on old equipment. So what happens? This is in the 5th year. This is the first year for this, right? So some
Yeah.
depreciation of this and some depreciation of this added together,
Okay.
the tax shield will be more or less.
More.
Of course, see, depreciation of this is like 5 years, right? So 20,000 of this. And for this, again, some depreciation of the first year itself, right? See, some depreciation I bought this in 6 months. So let's say 6 months depreciation is 10,000, right? And the 6 months depreciation of this will be how much? Per annum it is how much? Divide by 5. 40.
40. Yeah.
So I will take at least 20.
Okay.
Correct?
But
So some part of this would be there and some part of this would be there. Okay.
okay. But for
So
old,
yeah, see what happens. Previously the depreciation shield you were taking only on 20, right? So
yes.
on 20, what were you taking? Now you'll be taking on 30 and later on 40. So it will be greater, right?
Yeah. Right. Okay.
So that's what I'm saying. It will be greater than that during the earlier years.
Yeah. Okay.
Correct?
Yeah. Got it.
And this is not the option. We can easily determine the information is clearly given. Wrong. Less than during the early years. How? Because the newer equipment depreciation expense will be higher, right? Once the time of old equipment useful life has passed.
Mm.
So this is also wrong. Same. How come same? How come same? Because the depreciation expense on this will be different than this, right?
Yes.
That's what. Did you understand?
Yes, sir. Got it. Hi.
Next question. You understood, right? Shall we move forward?
Yes. Yes, sir.
Yeah.
Yes.
Which one of the following procedures would most likely help managers identify errors in their capital budgeting decisions?
Post audits.
Yeah, post audits, but scenario analysis is for risk actually. Okay, scenario analysis is a process of analyzing possible future results based upon various assumptions. So we generally see the risk actually. Okay, risk based on study the risk based on assumptions.
Okay.
Okay, value engineering is like reaching targeted cost levels. It is systematic approach to assessing all aspects of value chain cost build up for a product. So this is related to cost. What are they asking? Which one of the following procedures would most likely help identify errors? Errors is always you do audit, then only you'll get, right? This will check the randomness actually, whether something like errors in managers' capital budgeting decisions are under the control of managers and thus not random. See, this checks randomness. Randomness means what? Like you don't know the outcome actually. Okay. See, when you are randomly picking many things out of your data, That is a Monte Carlo simulation method is based upon see random numbers we have seen, right, in simulation when we were doing.
Yes, sir. Yes.
So this will check randomness, but you know the managers, whatever the like capital budgeting decisions the managers are making, that are under control of whom? Managers. They know many things beforehand, that if they don't perform certain things, certain outcome is going to come. So they know what they are going to do, and they know the outcomes also. So how come it is random? It is not random, right? Random means what? You don't know what you're going to do, and you don't know the outcomes also. Are you
Mm.
understanding?
Yes, sir.
I
Got.
have a box and there are many chits. Our parking, our in our society, the parking was allotted, right? That was on random basis. No one knew what they are writing on the slip, and they did not knew the flat numbers, because some slip was taken randomly, flat numbers was written randomly, parking slot was written, and the chit was put into it. Okay. So who, no one knows, right, what's the result?
Yes.
You understood, right, Samreen?
I got it. Yes. And
Hello.
hello.
Yeah, okay. No, no, no. Like, yeah, it may be a very new thing. See, it's not your mistake also. Monte Carlo simulation is not there in detail in this. Value engineering is not there in detail in this. Scenario analysis is not there in detail in this. Audit also, you know, like because we know some general, we know generally what audit is, we kind of give answers. So it's not the mistake of the student also. They don't have knowledge of all this, which I need to share. So I need to convince you, right? Now,
Yeah.
now, next question. These are very challenging questions.
Okay.
So the Murray Corporation is considering the acquisition of new machine. Machine can be purchased for $90,000. It will cost $6,000 to transport to Murray's plant and 90,000 to install. So you understood purchase cost and transportation cost, and this all would be added, right?
Yeah.
And it is estimated the machine will last 10 years, and it is expected to have an estimated salvage value of 5,000 over its 10-year life. The machine is expected to produce 2,000 units per year, each with a selling price of $500 and combined metal and labor cost of this much. So this and this, you know, is going to give you revenue and labor cost. You can find out the cash flows every year cash flows, right? And the tax rate is 40%, and the straight line method is used 5 years is the depreciation. Okay. So now my question to you is third year net cash flow. See, this I'm expecting you to do, Samreen. I want the answer
Okay.
because I've taught this right now. Okay.
Mm.
So no problem. I'll support you even. The hints I've given you, this minus this will give you the sales minus cost will give you the per unit cash inflow into this number of units will give you third year operating cash flows, right?
Hello.
Hello. Yeah. Can you hear me?
Yes, sir.
Hello.
Your voice is not audible. Hello. Yes, sir. Now I
Yeah.
can
Now
hear.
it is not. Now, yeah. So see, yeah, revenue minus cost is going to give you cash flows, right? So to 500 minus 450, 50
Yes.
into 2000 units is going to give you cash flows, operating cash flows. And rest you have to do depreciation, tax shield and all. So I'm waiting. Okay. Then I'll discuss if you're not getting. Okay.
Okay.
Just try this. I'll be back in a second.
Okay. Hello. Hello.
Yeah. Have you done? So shall we solve? So see here 1,100,000 is what we are getting the cash flows every year, right?
Yes.
And we need to remove the tax also from this, right?
60%. 60,000.
Just a second. So we will first find out the depreciation tax shield. We'll at once we will try to remove. Okay. So what is the depreciation tax shield? This like 9 plus 6, 15 and 90,000.
1,05,000.
So 1 lakh, yeah, 1,05,000 divided by 5 years. It's going to give what? 21,000, right? Into 40%. What is that?
85.
Sorry. So
8,400.
no, we will. Yeah, no, we will take up that one in this only. 21,000 will consider in this only, right?
Mm.
Or else like what is the 60%, 40% of this will take 60,000 and 40% of this we will remove. We will take 60% of this. So can you tell me what's the amount? Hello.
12,600. Sorry.
12,000.
600. 12,600.
60% of this.
Yes.
Okay, and then so 12,600, right? And anything else is there? Anything we are getting any scrap value or something? No salvage value. So we aren't getting the answer, right? Just a second. So 72,600 I'm getting. See, 1 lakh we got. Depreciation tax shield is 21,000. Okay. So the depreciation tax shield is 12,600. So after tax cash flow we are getting 21,000. Oh, I'm sorry. You take 40%. That is a mistake I did. Okay, 8,400. You would have told me we should not take 60%, right? Hello? Hello? Hello?
Hello, sir.
Yeah,
Yes, sir.
Samir, you
I
have.
said, but
Yeah, I was carried away. I think didn't listen. So 68,400. Okay, right?
60%.
This is the answer. Okay. Next one.
68,400.
Yeah, we did now. So I
Yes.
removed the tax from this and I took the depreciation tax shield. That's it. Shall we move forward? Okay. Yeah. You're noting it down? Okay, note it down.
Yeah. No, sir, I got it.
Okay, so solve the sixth one.
Okay.
A firm is replacing a grinder purchased 5 years ago for $15,000 with a new one costing $25,000 cash. That means they bought it for this much and they are going to replace by this much amount. Original grinder is being depreciated on the straight line basis over 15 years to zero scrap value. Firm will sell this old equipment to third party for 6,000 cash. The new equipment will be depreciated on straight line basis over 10 years to a salvage value of zero. This is the marginal tax rate and the firm's net cash investment at the time of purchase of the old grinder sold and the new one purchase is what? That means two things are happening. What is the firm's net cash investment at the time of purchase of old grinder is sold and new grinder is purchased, right?
Mm.
So we will see like the old grinder. A firm is replacing a grinder purchased 5 years ago, right?
Mm.
So what is its carrying amount we have to see, right? So 15,000 is the cost, correct or wrong?
Yes.
Its life is how much years?
5 years.
15 years they're going to depreciate, right?
Okay.
And we are buying this new one when? Just a second. So old one they are selling and new one they are purchasing. Okay. So I think 5 years is the time they are like it's going to happen. They are speaking it on today, right? 5 years ago they bought it for 15,000 and the new one is costing 25. So fifth year they are speaking about fifth year. Am I right? They are buying and they are selling, correct?
Yes.
Hello.
Yes, sir.
Yeah, so 15,000 and the depreciation is 15,000 divided by 15. That means 1,000 into 5 will be 5,000. So if I remove 5,000 from this, 10,000 is the cost in the fifth year, right? Of the old machine. Yes.
Yes, sir. Right.
They are selling it for how much? 6,000.
1,000 cash.
So loss of 4,000. Okay. 6,000. This is the cost. This is the selling price. Loss. So loss will give them benefit, right? 40%.
Yes.
1,600. Correct?
Yes.
So the inflow is they are selling it for 6,000 and they are getting a benefit of this. So 6,000 plus 1,600.
Yeah.
7,600 is the inflow, right?
Yes.
And the outflow is what actually in that year itself 25,000. Inflow from the old machine in the fifth year and outflow for the purchase of new machine in the fifth year, right?
Yes.
What is the net? Can you do the netting?
1,400.
How much?
17,400.
Yeah. This is the answer. Okay. Shall we move forward if you're done with this?
Just note it down.
Yeah. My battery is about to die. Okay, almost class is also done, right? Tomorrow also I'll take a class. Maybe we'll reach 20
Okay.
by tomorrow, and one more class this weekend we'll take. Then on Saturday, probably. Or I'll see if Wednesday I'm not going or something. I'll inform. I'll take the class. Most probably I'll go. Then next long-term financial management. Sunday onwards I'll start. Okay.
Yeah, 1,000 into 5 is
Which one?
15,000 divided by 15, we got 1,000 into 5. 5 years.
Yeah.
Okay. Done.
So what is the next question? The maximum benefit foregone by using a scarce resource for a given purpose and not for the next best alternative is called opportunity cost.
Not for not for next best alternative.
See, maximum benefit foregone by using a scarce resource for a given purpose and not for the best like next best alternative. See, opportunity cost is maximum benefit foregone by using a scarce resource for a given purpose. That means you have some money, let's say 10,000. You want to spend it, okay? So you will be spending it. You want to take maximum benefit of this or not?
Yes.
So maximum benefit foregone. Then if you are foregoing that benefit, suppose you are getting some benefit from that, but you're foregoing that, okay? Okay, and not not the next best alternative. See, opportunity cost is the maximum benefit foregone by using a scarce resource for a given purpose and not for the next best alternative. So what happens in capital budgeting? The most basic application of this concept is the desire to place the company's limited funds in most promising capital projects. Okay.
Okay.
Whatever the money you have to put it on the best one, right? Choosing the best out of the rest, I would say.
Yes, sir.
Maximum benefit foregone. That means you're not taking the maximum, you're leaving that maximum benefit by using scarce resource. Why are you leaving? Because you want to put into the best one, right?
Next best benefit.
Yeah, you want to put it to the best one.
Yeah.
So if you are leaving the maximum benefit you're leaving by using a scarce resource for a given purpose, you are only leaving because you want to put it in the best one and not for the best next. You're not choosing the best next alternative. You're putting it into the best project. Let's say you become a chartered accountant. Either you can practice or you can do a job, right? But you're not taking you're not starting a business. It can be the best alternative, but you're not starting a business, right? Given whatever resource you have, you can either put into this, you can either put into this. So if you want to put it into job, then you have foregone this, right?
Yes.
But are you choosing the alternative? Completely different one.
No.
Business can be a very good alternative for you, but you're not doing that. That's it.
Okay.
So we'll stop it here and we'll take up from 8th question tomorrow. Okay, Samria?
Okay.
Okay then. Thank you.
Thank you.
Thank you.
Thank you.